791,000 ounces of silver drained from COMEX in 3 days, not from eligible inventory, the metal sitting in vaults with no delivery obligation attached to it, from registered inventory, the deliverable pool, the physical buffer that is supposed to stand between the exchange's paper promises and the real world. And that number didn't come out of nowhere. It came on top of a 15-month bleed that has already pulled more than 51 million ounces out of COMEX warehouses in the last 30 days alone. If you understand what registered inventory actually is, and most people watching financial media do not, then you understand why this matters so much more than a headline price move. And if you want to keep understanding things that the mainstream narrative refuses to explain, hit like and subscribe, because what I'm walking through in this video is exactly the kind of structural analysis this channel exists for. Here's what you need to know before we go any further. COMEX is not a silver exchange in the way most people imagine. It is a futures exchange that happens to have physical metal attached to it. Barely. The futures contracts traded on COMEX represent paper claims. Each standard contract is a promise to deliver 5,000 ounces of silver. The exchange works on the assumption, baked into its very architecture, that the overwhelming majority of those contracts will never result in physical delivery. Traders roll their positions forward, take cash settlement, or close out before the delivery window opens. That assumption is what allows the system to function with a fraction of the physical metal that the paper claims suggest it needs. For decades, this worked. The leverage ratio, paper claims relative to actual deliverable registered silver, sat in a range that felt manageable. 40-to-1 was considered normal, 60-to-1 during periods of elevated speculative interest. Right now, that ratio is not 60-to-1. According to data from the CME's own publicly available vault reports, there are approximately 7 paper ounces in outstanding contracts for every single ounce of registered silver sitting in COMEX warehouses. 7-to-1, and that number is getting worse every week. The core causal mechanism driving everything you're about to hear is this: the structural assumption that physical delivery demand would never breach a certain threshold has now been invalidated, and the entire system is being stress tested against reality in real time. Stay with me, because this next part is where the mechanics get precise, and most people lose the thread. Registered silver is the exchange's true liability. It is the metal that has a warehouse warrant attached to it, meaning any holder of a long futures contract who stands for delivery has a legal claim against that specific pool of metal. Eligible silver sits in the same vaults, but it is privately owned, not designated for delivery, and the exchange cannot use it to satisfy delivery obligations unless the owner chooses to convert it. When you see COMEX total inventories quoted, you are often seeing a number that includes both registered and eligible combined. As of the final week of March 2026, total COMEX silver inventory has fallen to approximately 328 million ounces, but the registered portion, the only number that actually matters for delivery stress, has collapsed to 76 million ounces. Against that, open interest represents paper claims on 569 million ounces. That is the real picture, not 328 million ounces of coverage, 76 million ounces of actual deliverable metal, standing against contracts that could legally demand 569 million. The reason this is happening now and not 5 years ago is not random. There are 3 distinct structural forces converging simultaneously, and each one operates through a different mechanism. Together they form a causal chain that is extraordinarily difficult to interrupt without a structural break somewhere in the system. The first force is east-west physical arbitrage, and it is mechanically simple, even though its consequences are enormous. Shanghai has been trading physical silver at a sustained premium to New York. The gap reached $4.40 per ounce in late March 2026. To anyone with access to both markets, that premium is free money. You buy silver cheaply on COMEX by standing for delivery, you pull physical metal out of registered inventory, you ship it east, and you sell it in Shanghai at the higher price, you pocket the spread. The incentive is not ideological or conspiratorial, it is purely mechanical, and it will continue operating as long as the premium exists. Every ounce that moves east is an ounce that leaves COMEX registered inventory permanently. It does not come back, and the drain has been running for 15 consecutive months. December 2025 produced 65 million ounces in physical deliveries from COMEX, a single-month record. January 2026 followed with 49.4 million ounces, more than 7 times what January 2024 had generated. The second and third order effects here are what most commentators miss entirely. As registered inventory falls, the coverage ratio deteriorates, which increases default risk perception, which causes more sophisticated holders to accelerate standing for delivery before the pool gets too thin, which accelerates the drain. This is a self-reinforcing dynamic. The arbitrage does not just drain inventory, it destabilizes the confidence structure that the entire futures system depends on. The second structural force is the sixth consecutive annual supply deficit, and it operates on a different time scale, but with equal mechanical certainty. The Silver Institute has confirmed that 2026 will be the sixth consecutive year in which silver demand exceeds mine supply. The cumulative 5-year deficit through 2025 already exceeded 800 million ounces. An entire year of global mining output consumed in excess of what was produced. Physical investment demand is projected to surge 20% to 227 million ounces in 2026 alone. Now think about what a structural deficit actually does to a commodity system over time. Each year of deficit draws down above-ground stockpiles. Those stockpiles are finite. And the silver being consumed industrially, in solar panels, in electric vehicle components, in AI data center cooling systems, in advanced electronics, is not recoverable in any economically meaningful way. It is consumed, destroyed, gone from the above-ground inventory pool forever. Industrial demand alone is projected at 650 million ounces in 2026 against total global mining supply of approximately 1,050 million ounces. And global supply is only expected to rise 1.5%. The gap does not close on its own. Mine supply cannot respond quickly. The average lead time from silver discovery to production is between 7 and 10 years. So every year the deficit runs, the physical buffer gets thinner, and the marginal cost of any demand shock gets higher. The mainstream narrative treats the deficit as a background condition. It is not. It is a compounding structural fracture that gets worse every quarter regardless of what happens to futures prices. But here is the part nobody understands, and it is the third structural force. The delivery system's own internal mechanics are now creating a feedback loop that amplifies both of the forces I just described. On March 19th of 2026, the same session that silver experienced its intraday flash crash, the CME's house account absorbed 114 out of 138 delivery notices. That is 82% of a single day's entire delivery flow running through the exchange's own clearinghouse account rather than through independent counterparties. Through March 20th, approximately 43.4 million ounces had already been delivered in the March 2026 contract cycle against a registered pool of 79.2 million ounces. When you see the exchange itself absorbing the majority of delivery activity in a single session, you are watching an institution managing concentration risk in real time. The CME is not supposed to be the dominant physical buyer in its own delivery system. That concentration is a stress signal, and the structural implication is profound. If independent counterparties are stepping back from absorbing delivery flow, if the exchange itself has to fill that role, then the normal price discovery mechanism that should bring physical silver to market is breaking down. The incentive structure for paper shorts to cover with physical metal is being replaced by the exchange managing its own exposure. That is not normal. That has never been a normal operating condition. And this is where things get structurally dangerous. When the delivery system begins absorbing its own flow, cash settlement risk rises. Cash settlement is the emergency valve, the mechanism by which COMEX can satisfy delivery obligations with dollars instead of metal when physical supply is insufficient. Most retail investors think cash settlement is a neutral outcome. It is not. Cash settlement at current paper prices would represent delivery below the physical market price in Shanghai. It would instantly prove what the East-West premium has been implying for 15 months, that paper silver and physical silver are not the same thing. The moment cash settlement is used at scale, the paper price loses its function as a reference price for physical metal, and once that confidence breaks, it does not slowly recover. It reprices abruptly. Now let's project forward using exactly the causal chain we've established, because the mainstream narrative is structurally incoherent at this point. The consensus view is that the silver price surge earlier in 2026, the metal breached $100 per ounce for the first time in January, was a speculative spike driven by retail momentum and short-term investor demand. That framing is wrong, and it is wrong in a specific mechanical way. Speculative spikes reverse when speculative money exits. They do not leave behind a 65 million ounce single-month physical delivery record. They do not leave behind 15 consecutive months of structural vault drain. They do not leave behind a registered inventory pool that has declined by 31% in just a few months. What we are watching is not a speculative surge correcting itself. It is a physical delivery system being systematically drained, with price suppression via paper markets providing the arbitrage window that makes the drain profitable. The flash crash that briefly knocked silver off its highs in the third week of March 2026 was not the market finding fair value. It was margin pressure and paper position liquidation. The physical drain continued without pause. The vault data does not lie. The COMEX registered pool is now sitting at 76 million ounces. The leverage ratio is 7 paper ounces for every real ounce. And the Silver Institute has confirmed a sixth consecutive structural deficit. Policymakers and exchange operators face a genuinely impossible set of choices from here. If the CME raises margin requirements aggressively to suppress open interest and reduce the paper-to-physical leverage ratio, they will trigger exactly the kind of forced liquidation that appeared in March, but this time without the registered inventory buffer that existed 6 months ago. If they allow the current delivery pace to continue, registered inventory could fall to levels where the system literally cannot honor its contractual obligations in metal. If they move to cash settlement at scale, they validate the physical market's verdict that paper prices are fictitious. There is no option here that does not involve a structural break somewhere. The question is which break they choose, and which break the market forces on them before they can choose. We are currently at the point in this causal chain where the feedback loops have become self-sustaining. The East-West arbitrage continues draining registered inventory. The structural deficit prevents replenishment. The delivery system's internal concentration signals stress at the clearing level, and the leverage ratio ensures that even a modest acceleration in delivery demand relative to current levels could cascade into a coverage crisis with very little warning. Here's the blunt structural assessment. Silver right now is the most under-leveraged hard asset relative to its physical supply reality of anything trading in major markets. Every cycle of commodities suppression via futures paper eventually meets a physical constraint that the paper system cannot intermediate away. The constraint in silver is not theoretical, it is not coming. It is already operating, visible in vault data, delivery records, and the East-West premium that has been running for over a year. The registered inventory pool has been cut by nearly a third in just months. The cumulative 5-year supply deficit now exceeds an entire year of global mine production. 6,615 contracts, representing 33,075,000 ounces, stood for physical delivery in just the March 2026 cycle alone. These are not speculative abstractions. These are contractual claims being exercised against a pool of metal that is measurably, verifiably shrinking. The investors and institutions who understand that the paper price of silver is currently set by a system that cannot physically backstop its own contracts are positioning ahead of a repricing that has no precedent in the modern era of the exchange. Not a repositioning based on sentiment, not a trade based on technicals. A structural repositioning based on the mechanical reality that paper claims cannot exceed physical supply indefinitely without a correction. And the correction, when it comes, does not move in an orderly line. The question you should be sitting with after this video is not whether COMEX has a physical silver problem. The vault data has already answered that question. The question worth asking is this: if one of the most critical industrial metals on Earth, used in every solar panel, every electric vehicle, every advanced semiconductor, is trading primarily through a paper system that holds 7 ounces of paper claims against every single real ounce in its deliverable vault, and that vault is draining at 50 million ounces per month, what does the price discovery mechanism actually look like the day the paper system has to admit the physical is gone